Good afternoon, ladies and gentlemen, and welcome to the Alpha Financial Markets Consulting PLC interim results investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged. They can be submitted at any time via the Q&A tab that's just situated on the right-hand corner of your screen. Please just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company can review all questions submitted today and will publish all those responses where it's appropriate to do so on the Investor Meet Company platform. Perhaps before, if we may, I could just submit the following poll, and if you could give that your kind attention, I'm sure the company would be most grateful. And I would now like to hand you over to the executive management team from Alpha FMC. Luke, John, good afternoon.
Good afternoon, and good afternoon, everyone. I'm delighted to be with you today and with my colleague John to present our interim result for the 6 months ended on the 30th of September 2023. So I will go straight to page 3. So first of all, I will give you the sort of key highlight, and then John will provide more details on key financials, and then I will present our market overview and our outlook. So we'll take, I think, the question at the end of the presentation. So let's go on page 5. And so page 5 is, the 8 key points that we wanted to communicate today. So the first point is, so as noted in June, we knew that market conditions of the short term were going to be challenging, but Alpha has been resilient against this backdrop, and our top line growth is over 7%. Second item is we've made the very conscious decision to maintain our price point. So we achieved consistent consultant day rates, but the utilization of our staff has been lower than our target levels. Number 3, as planned, again, we have applied a very selective hiring policy, and we have added 38 consultants organically, and this includes our committed grad intake to ensure really group future talent pipeline. 4, we have added 9 directors organically through our normal internal promotion, as well as 3 insurance consulting directors, 2 of which in North America. So during this challenging time for consulting in general, we keep investing in our people to build the foundation for future growth. 5, we completed on that first half the acquisition of Shoreline, consolidating our presence in APAC, and where we are now really the leading player in asset and wealth management sector. 6, again in line with what we noted in June, we have seen a lengthening sales cycle and increased competition. And this is a result of overcapacity in the global consulting market. And this market is really in a process of rebalancing supply and demand. So as we noted in June, we expect this to be a short-term feature, but we are also cognizant of a wider macroeconomic and political uncertainties. So the sentiment at Alpha is improving, but we are still in the middle of those turbulences. 7, so Alpha is navigating well through those turbulences. Our consulting team utilization ticked up from summer lows in September and further in October, and again further in November, closer to target level. And we expect this trend to continue to increase through the second half of the year. 8, so we enter now that second half of the year with a strong and high quality pipeline, and therefore we continue to expect to deliver full year results in line with current market expectation. So just turning the page. So what does that mean in numbers? So net fee income grew by 7.2%. Gross profit is flat. Adjusted EBITDA is down. And we recommend to maintain interim dividend. I will now hand over to John to give more color and more details on the key financials.
Thank you, Luke. And good afternoon. On this page, a reminder of Alpha's strong growth track record, almost 30% top line CAGR since IPO. And that growth is based around our quality proposition, building strong client relationships, cross-selling and expanded service offering and skill sets, repeating that model internationally, all supported by growth in our quality consulting teams. And the growth has been mainly organic historically. Our largest acquisition was Line Point back in May 21. And this year, continuing to grow the top line in the first half with margins reflecting the overall market environment that Luke references. So as we turn over the page to the P&L, we're pleased with the resilience, as Luke notes, in the first half, given the market environment. Top line up 7.2%, flat gross profit, and reduced margins on lower utilization. So stepping through briefly, the top line is up almost 8 million in the year on a very strong comparative last year. And most of that overall growth is organic, with around 1 million from the Shoreline inorganic contribution from the first 5 months since its acquisition date. And there's also 1 million of FX headwind at the top line, meaning 8.5% constant currency growth uplift this half. So the top line improvements reflect the ongoing demand supported by headcount growth, with the utilization reducing through the half alongside broadly consistent rates. And while the headcount growth is up overall from the comparative, most of this is a run rate averaging from recruitment through last year. As Luke notes, approximately 40 heads added organically in H1, the majority of which were our September grad program, which we retained. And of course, we expect the second half headcount to have a flatter profile with our ongoing selective recruitment policy in place. So the gross profit level, the gross profit is flat on last year at 38.4 million in the half, and the margin reduces 240 basis points half on half. And this reflects the reducing utilization through the half alongside flat fee rates, while variable costs also adjust. Utilization averaged close to 65% in the period, with a particular pronounced summer low, which has lifted from September onwards into October also. And in the flat and overall environment, the flat fee and overall environment, we have flexed the variable cost base. So the gross margin is a product of those flatter fees, utilization averaging below our 70% target levels, offset partly by managing the variable cost base overall. At adjusted EBITDA, 20.1 million reported at a margin of 17.5%. And the admin line increases around 2.4 million to 18.3, mainly from the flow and the run rate of headcount movements and increases with the business growth from last year running through into this half, and some upward movements in IT licenses, staff, office space, etc., around cost related to the larger team size. Overall, the admin costs represent around 16% of net fee income in the half, in line with the historical range of 15 to 17%, and we'll continue to manage the admin line in line with the growth and business drivers. So in summary, we have traded resiliently, largely held our rates in the competitive market environment, and managed our costs appropriately. This market overcapacity, as Luke mentions, we view as short-term and has affected our utilisation in the half and hence margins. Today, trading is tracking to our view of an improving third quarter. Utilisation has returned closer to the 70% target overall in October on average across the group. And we expect this to further improve in November and into the final quarter. So we're encouraged by the improving market sentiment. We continue to see good client demand for our services and have a strong pipeline of new business opportunities, albeit the market remains competitive, and we've yet to see any significant change to the lengthened sales cycle we've reported as the market continues to rebalance. Therefore, we continue to be on track and expect the full year results in line with the current market expectations, although clearly with rising utilisation leading to a second half and Q4 weighting. And Luke will talk more about the market later. The other captions on the page are relatively straightforward, with depreciation flowing through to the adjusted profit after tax of 13.5 million. We'll talk of the adjusting items in a moment. And the interim dividend, as Luke notes, maintained at 3.7 pence, in line with last year's payout. Over the page, the geographic performance. Just stepping through this page, we've seen growth across all regions on a constant currency basis, mainly organically. And the gross margins in each of the regions are reflecting the lower utilisation with generally flat rates. We're stepping through each in turn. The UK saw strong 14% overall growth, half on half, entirely organically. And that was driven principally by double-digit fee income growth in our UK alternatives and insurance consulting teams. Those teams grew their headcount most in insurance and alternatives, and much of that was last year, with the UK team only growing around 26 overall since the year end, mostly the insurance team and our grad programme. UK rates were overall flat through the half, and we've managed our variable cost base to performance. So that utilisation movement explains the margin, the gross margin in the UK. The UK starts the second half with improving trading and utilisation back close to the 70% levels and a good pipeline. In North America, a flat top line reported in sterling and 2% growth in constant currency terms. And this is after, of course, really strong growth last year, and the North American business consolidating through this half and a period of market rebalancing. Again, we grew the overall team, and that recruitment weighted from last year, with the North American team growing about 23 since the year end, mostly the grad programme. Rates in North America were also broadly consistent, half on half, and utilisation decreased. So gross margin was 31%, and again we've focused on managing our variable costs and balancing a flatter rates environment, reflected in that gross margin. So the North American region starts H2 with improving trading and utilisation back above 70% levels and a strong pipeline, particularly strong demand backdrop in the alternatives business. And finally in Europe and APAC, they also grew top line almost 12% overall, of which over half is organic growth plus the Shoreline acquisition. Headcount again grew, including Shoreline. Utilisation wound back. Rates made some progress in the region, which, alongside managing the variable costs, offset the utilisation unwind. So that's all reflected in the region's gross margin. And Europe and APAC starts the second half with utilisation ticking up, and having been growing its pipeline strongly over the summer months, now has a good level of opportunities for the full year. Moving then to the adjusting items, and these are consistent captions that we report on each year. Two things to pull out on this page. the share-based payment charge and the earn-out deferred consideration line. So the share-based payment charge obviously is the management incentive scheme to incentivize the teams globally. And that charge has decreased in the half and reflects both the awards cycle of vests and awards maturing into balance since IPO. And this half, the assumption updates reflect first half share price movements and the expected lower level of vests this year given performance. We expect the full year charge to remain between 7 and 8 million for this year, and then a flatter, more normalised profile in line with business growth. And we should note that we continue to adjust for the share-based payment charge from our adjusted EBITDA, given the variations and drivers of the share-based payment charge. And you'll note in the RNS, we again show adjusted EBITDA both with and without share-based payment charges, including margins on both bases also for clarity and transparency to shareholders. And secondly, the earn-out and deferred consideration line it reflects the ongoing employment-linked line point and shoreline consideration being expensed in the P&L, and this half back to a more normalised charge after the fair value adjustment last year for Obsidian. The other captions on the page, I think, are self-explanatory: diligence costs for shoreline and the unwinding of deferred consideration discount as previously. So the standard adjusting items again. And then over the page on the balance sheet, a robust balance sheet maintained, over 16 million of net cash at 30 September, and three key points to highlight here. Firstly, receivables. The trade receivables continue to be well managed. Debtors are at a very similar level to the first half last year, and slightly widened from March as usual. Nothing unusual to note. Client terms remain very consistent. The acquisition-related liabilities you see on the page fall by over 12 million from March, reflecting the 19 million of acquisition payments in the period, plus the shoreline acquisition liability additions and further employment linked and discount unwind. Otherwise, the payables movement of the 11 million decrease since March reflects profit share, of which more on the next page. And finally here, the RCF was undrawn at March and drawn 10.2 million at 30 September. Drawn temporarily to manage our sterling and currency balances. So in summary, a robust balance sheet maintained at 16 million of cash, which should build again with trading through the second half. And then finally, on the finance section, the cash flow, and at the top of the page, the bridge illustrates clearly the first half 5.4 million operating cash outflow. And therefore, the non-operating 19 million of acquisition payments, the 12 million of dividends, and the 4 million of EBT share purchases are all from the year-end cash balance. And it's important to note that there's no underlying material change from our good cash conversion and collections. But a couple of key points to note and reconcile to the headline conversion numbers and the cash outflow in the half. Firstly, you probably know that Alpha pays its bonuses and profit share in the first half of the year, in the summer months, after the prior year is complete, and that always suppresses our first half cash conversion. And this half, these timings are more pronounced. Firstly, two things to note: given the strong performance of last year, we paid in the summer of 23 good bonus payments out of a smaller first half operating cash flow, and that ratio has changed given those relative positions this half. Further, as you see in the bridge, the working capital swing is exacerbated also by accruing in the first half lower profit share levels given performance to date this year. And those lower profit share bonus accruals are the key items swinging the working capital further this half. So combined, those affect our cash conversion in this period. So the underlying conversion remains good. With this profit share effect washing through, conversion should improve in the second half, although we're mindful of the Q4 weighting to trading this year, which may result in less cash collected by the year end. Therefore, we're guiding, as you see, to approximately a 50% conversion overall FY24, returning the cash balance to closer to 40 million by March. However, these factors are timing. Nothing's changed in the underlying capital-light nature of the business, and this should rebalance over time. So overall, good underlying cash conversion, and we should build back to a stronger cash position by the year end. And with that, I'll hand back to Luke.
Yeah, thank you. Thanks, John. So, market overview and outlook now. I guess the idea here is really to summarize the key message for that first half. So really the first key message is we have been resilient. So as noted in June, we knew that market conditions on the short term were going to be really challenging, and Alpha has been resilient against this backdrop, and our top line growth is over 7%. We have held firm on our price point, but utilization of our team has been lower, and this leads to a reduced profitability. We have managed our cost base appropriately while still investing for the future growth. And last but not least, we maintain a robust balance sheet. So the second key message is that we progress step by step towards our strategic ambition. And as you know, insurance sector is a key pillar of our strategy. And we have added 3 new directors, including 2 in North America. Generally, we have recruited very selectively in key growth area of our business. And with Shoreline acquisition, we have consolidated our market and the market in asset and wealth management in APAC. So now, what's next? I would say what is for the future. So first of all, on the short term. So in line with what we noted in June, we have seen a lengthening sales cycle and an increased competition. And this is a result of overcapacity in the global consulting market. This market is in a process of rebalancing supply and demand. We expect this to be a short-term feature, but we are also cognizant of wider macroeconomic and political uncertainties. So we are still in the middle of turbulences, but the sentiment is improving. We enter the second half of the year with a robust pipeline, and we see the utilization of our team improving, and we forecast this utilization to improve in Q3 and further improve in Q4. Therefore, we expect to deliver full year result in line with market expectation. On the long term, in March 2023, we set out our strategy to double the business again in the next 5 years. And we remain very confident in our ability to achieve that ambition. The long-term market drivers that really underpin client demand for consulting remain very strong, and our strategy remains unchanged. So 1, we have the best talent. 2, we have the best expertise with our very specialized proposition in asset and wealth management sector, alternative sector, and insurance sector. 3, we have the best culture. And actually, 3 weeks ago, we received an award of the best company to work for in the UK. And this year, we made it to the top 10 overall companies in the UK, which is honestly very impressive, given our very recent development and moving to the large company category. 4, we have the best service, and our focus on delivery excellence is absolutely relentless. So in summary, we are very excited about the opportunity ahead of us. Going maybe to the last slide now, and some of you have probably seen that before. The point we want to make here is those 5 fundamental drivers that support demand for consulting are very much there, and I would say more than ever. Long-term growth of asset under management and insurance policies that push our client to innovate and expand. Regulatory environment that keep changing all the time. Cost pressure and fierce competition that lead to major efficiency program or even M&A to achieve economies of scale. Client and societal expectation like ESG product or digital experience. And last but not least, technology breakthrough that really create an unprecedented opportunity to make quantum leap in terms of efficiency gain. So financial services sector is going through a major wave of transformation. The frequency, the magnitude, and the complexity of those transformation keeps increasing on the long term. And this fundamentally drive the demand for our service. So we remain very confident to achieve our ambition to double again the business by 2028.
Luke, John, if I may just jump back in there, and thank you very much indeed for your presentation this afternoon. Ladies and gentlemen, please do continue to submit your questions just by using the Q&A tab that's situated on the right-hand corner of your screen. But just while the team take a few moments to review those questions that were submitted already, I would like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. John, Luke, as you can see there in the Q&A tab, we have received a number of questions from investors that were both pre-submitted and those that came in during your meeting this afternoon. And thank you to all of those on the call for taking the time to submit their questions. But Luke, John, if I may just hand back to you just to read out those questions and give your responses where it's appropriate to do so, and then I'll pick up from you at the end. Thank you.
Yes, surely, Jake, thank you. And maybe Mark asked a question around the factors contributing to the revenue growth in this competitive market, and the key drivers, and when also can we see the operational gearing drop through to the bottom line. Shall I start, Luke, with that? Yeah. And let you add. And I think in terms of the growth this year, or in this half, you can see growth across all the regions. Overall, the particular parts of the business that we would probably pull out would be alternatives and insurance, which have grown half on half in the period by the most overall. In the alternatives market, we see very robust demand continuing in that space as private equity firms, credit funds, etc., continue to invest in their infrastructure. And I think, as Luke just referenced, I think those underlying drivers in the marketplace, costs, technology, regulation, societal expectations, etc., those firmly remain in place. And while this is a more competitive market overall, and continues to rebalance, those drivers are fundamentally in place and drive demand for our services. Clients are still looking at medium-term cost-saving plans, etc., and signing off those transformation plans and seeking our help to implement them. So that's why we remain, as Luke states, firmly of the belief in doubling the business with the vision of doubling the business by 2028. And in terms of the second part, the operational gearing, this probably getting to this year and the shorter term again. In the second half, we've talked of in the presentation of our utilization ticking up towards the end of the first half from the summer lows, now around target levels. And we would anticipate that through the second half, as we maintain our selective recruitment policy and therefore a flatter team shape overall broadly, that strong demand pipeline that we have falls through into revenue. And as we hold the team shape, we drift the utilization upwards through the remainder of the second half, and slightly above 70%, and that flows through to a higher margin in the second half than the first. And overall, that's the shape that we have that takes us to the delivering market expectations this year. I'll pause there. Luke, anything else to add to that, or
no, nothing. I think you cover all the points, so nothing to add on that question.
Great, thank you. And perhaps the opposite of that question is another question, which is around how would a recession in the developed world impact revenue and profits? Would we defend profitability by cutting costs or accept short-term decline to maximize long-term growth? And I think that is, if I start and hand over, I think that is exactly what we're balancing this year as we step through this half. Is in a more competitive environment, we've firstly been more selective in our hiring and balancing the short term with still investing for the future. And we continue to do that, continue to invest in growth opportunities while obviously stepping through the market conditions just now as they continue to rebalance. And in terms of the levers we have there, obviously there are some variable costs in the business, and we can adjust those, and those do adjust with performance as we see performance levels. So we continue to step through balancing that short and medium term ambitions.
Yeah, I mean, I can just echo what you said, John. Maybe the only point I would add is that we don't follow completely the economic cycle of our clients. So, for example, when it is really tough time for some of our clients, it may trigger the kind of change for which we also have an offering. So if I take a very concrete example, Credit Suisse being in a very distressed situation, created an opportunity for UBS to acquire them. And that integration of two giants in the asset, wealth, and investment bank world is leading to a major program and needing a lot of consultants. So in a way, in tough economic situation, we see those kind of transformation program happening. And also we see some players willing to really make a radical change in their cost base and optimizing their cost base by transforming the way they operate. So it's not about reducing a little bit the budget every year. It's about really changing completely their operating model. For example, simplifying their IT architecture, where they have hundreds of different software, moving into an enterprise platform, which is a big program of change, but can really significantly improve efficiency. And the last example, in difficult times, for example, for the alternative business, the interest rate increasing has actually had an impact on private equity players, because the deal flow has been much lower than in recent years. But actually, it was the right time for them to actually focus a bit more onto their internal processes, platform, technology, data platform. And they've decided to actually, take that bit of pause on the deal flow to actually change the way they operate and invest into their technology platform and actually driving a demand for consultants. So clearly we are there each time there is a change. But overall, I would say still in the good times. So when the market are high and the economy is growing, we tend to see really a much bigger type of consulting demand for expansion, product innovation, etc. And we tend to see actually a bit more demand in those periods than the other period. But it is there are some competitive driver here that make our business more, I would say, not in line with the current economic cycle. Having said that, when we see another capacity on the market, that's where maybe the consulting market is struggling, not really linked to how well our clients are doing, but more on the consulting market itself. So that's the kind of nuances and color I wanted to give on that. And as John said, obviously, if we were to see a very much that imbalance of the market continue on the more medium to long term, obviously, on one side, Alpha is a company with a very strong culture, and we take care about our people a lot. But if we really see demand for consulting not picking up, which is not our scenario, to be very clear, but in case this happens, everything can happen. Obviously, we will need to take the right decision to readjust our size to the reality of the market. But we tend not to do this just for short-term things. We may have to do that if really the world is completely changing, of course.
Thank you. Another question in terms of the strategies geographically, Luke. What strategies are we employing geographically, and do they differ between each region? And this sounds like a question for you. I think I'm imagining the cubes across the growth opportunities in North America and insurance and technology consulting.
Yeah, so our strategy from a geographical standpoint, is very much to be a global player. And we are today a global player. So we definitely have a global platform. We've got probably 1/3 of our team now in North America, US, and Canada. Maybe 1/3, a bit more, maybe in the UK, and 1/3 in Europe and in APAC. So we are definitely a global player. We are not anymore a UK-centric company. And UK is still a very important market for us, and probably the engine room of the group today. But we definitely expand outside the UK. So I would define ourselves as very much global. UK being fundamentally a very important market for us. Obviously, that's where we have a presence on all our verticals: asset and wealth, insurance, technology, everything. So that's our strategy. I would say the growth market for the next 5 years are probably more in North America, which is a market for which we have still a lot of room to grow and a lot of market share to take, because Alpha is very much growing through taking market share and outperforming competition. And so we are probably at the beginning of the journey in North America. So it's not to say that we don't have growth potential elsewhere, absolutely not. But maybe in the US, the growth potential is even bigger. So that's definitely a big focus for us. It took us 10 years to really build that US sort of platform and foundation. Very few consulting companies with a European heritage have actually been very successful in the US. We have been, and we are there now. So we really want to use that platform to grow further and in a big way in the US.
Great. Thanks, Luke. And maybe the last couple. There's a question asking us to comment on risk management. And maybe if I start, and I think in risk management obviously covers a number of areas. And from a financial side, we're obviously focused on various KPIs, and we're managing the business against that utilization and managing the hiring, etc., to those levels and to where we expect the business to be going and growing in due course. And also in this environment, we're stepping through that. That's quite carefully and selective recruitment currently. And then across the wider spheres, we have been investing in our biz ops infrastructure over recent years. So we now have good-sized legal teams, a risk management team, as well as the IT, HR, etc. teams as well. So there are programs there to manage cyber risk, to be monitoring the legal and contractual risks that we enter with clients, and I guess most particularly in terms of service delivery to clients. There's a monthly process across the regions with the risk team sitting down with the business and discussing stresses and projects with clients and how to adapt and mitigate any such stresses. So that helps perhaps give a flavour of some of the risk management processes we have, and these things are on the monthly board agendas we have regionally that Luke and I join along with the group managing director. And in fact,
nothing specifically to ask. So we have a global head of risk for the group, and as John said, we cover all kind of risk we could have in the business. So in the annual report, we do have quite a big section explaining our risk framework and our risk policy. And I would say as a listed business, we definitely have a very robust framework to anticipate, mitigate risk. And as John said, our reputation is so important. We have a particular focus on delivery excellence and making sure that we anticipate issue before it happens. And so we've got a laser focus on that.
Yes, and actually a couple of last minute ones which I'll just cover off probably reasonably easily. And there's a question on AI for you as well, Luke. So a couple on utilization in the first half and what are we expecting for the second. So the utilization in the first half averaged around 65% in the first half, so below that at 70% typical level we see. And it is around that 70% level now. What are we expecting? We're expecting that shape for it to tick up through the second half as the strong pipeline we have comes through and on a relatively flat headcount base and lets the utilization tick up on average across the second half. That's the shape that we are anticipating. And in terms of also asked is the capital allocation policy, and are we willing to do share buybacks in certain scenarios? And in answer to that, what are the aspects of capital allocation? We like to maintain a net cash position overall on the balance sheet. We think that gives us some capital flexibility in delivering acquisitions, which are part of the strategy. So the dividend policy is to return 50% of the cash profits, the profit after tax, adjusted profit after tax to shareholders, as you can see, and we're maintaining that. And thereafter, the cash balance that we have, I think we view as being best deployed in accretive acquisitions and building, acquiring new services and skill sets and accelerating our growth in certain areas and regions and accelerating that strategy. We have, with our advisors, looked at the benefits of share buybacks, etc., and overall that wasn't convincing, and we think we have better opportunities to deploy the capital effectively in that way. But obviously, we'll keep that under review. And I think the final question is one for you, Luke. How do we leverage technology and innovation to enhance our services, and does AI play any role?
So that's really a very interesting question. So technology, first of all, is at the very core of what we do for our clients. So for during the Capital Market Day, and we've got the presentation which is available on our website for those interested. We really explain that our heritage is management consulting, but a very natural extension of management consulting is into technology. And actually, that technology consulting aspect is very important for us. And we definitely have a strong strategy to develop our technology consulting capabilities to go much more into the details of the integration of the software, configuration, development of the software. And this is very much an adjacent sector for us that we know well. So we definitely want to develop strongly in that space, as we believe that market is really big and really adjacent and very natural for Alpha. So technology is at the very, very core of what we do. Within technology, there is AI, which is a very broad term. So we have been working in data science in general for quite a while, developing predictive model for our clients. Our data and data science practice is very strong and going from strength to strength, because it is at the very core of the challenges and opportunities for our clients. So we always want to innovate and being very close to the next big topic for our clients. So hence we have absolutely developed that capabilities internally. More specifically on Gen AI, so generative AI, which is the new approach which has been democratized by ChatGPT and others. And we have actually a very active strategy in that space. So we don't make a big announcement on the market and creating an alpha.ai or whatever. We prefer to be very close to our clients and actually deliver for them. And 2 days ago, we've delivered a fantastic Gen AI project based on OpenAI sort of framework, creating an amazing efficiency gain for our client. And we have more and more projects like this. Where Alpha is playing a role here is we firmly believe that 3 or 4 big tech companies like Google and Microsoft and the like will really develop very strong large language models into the AI world, but very generic technology. And actually where really the big opportunity is for the world and for us is in the application of that approach to very specific sector-specific use cases. We don't believe, and I think very few people believe, that general AI will come very, very soon, or at least in the next few decades. So AI is very strong at solving some very specific topic. And this is an amazing opportunity for us because we are very niche, very specific on some of the verticals. So we've got a big opportunity for Alpha to deliver for our clients on that front, and we are learning as everybody else in the world on how to really leverage those technology. But I think the early success we have is already very, very impressive. So, and we also obviously actively think about how we can use this internally. So many big consulting companies have made some announcements, like Lilly for McKinsey. We are lower profile, but we are really working hard internally to see how we could leverage that technology to be more efficient ourselves. So we are absolutely embracing AI, but probably in true Alpha style, not making big announcements, but really working hard behind the scene to make it happen.
Perfect. Luke, John, if I may just jump back in there, and thank you very much indeed for addressing all of those questions that came in from investors. And of course, if there are any further questions that do come through, we'll make these available to you immediately after the presentation has ended, just for you to review, to then add any additional responses, of course, where it's appropriate to do so. And we'll publish all those responses out on the platform. But Luke, perhaps before really just looking to redirect those on the call to provide you with their feedback, which I know is particularly important to yourself and the company, if I could please just ask you for a few closing comments to wrap up with, that'd be great.
Yeah, sure. So, I mean, what to say? I would say financial services industry is really going through an unprecedented wave of transformation. And this sector, financial service industry, is at the very heart of the global economy. So, being a consultant in that sector means being at the forefront of the economy and wider society transformation. It really means being an actor, leading, shaping, driving the change. And I would say it's quite a cool place to be on the long term. And we are really very confident to double the business again by 2028.
That's great. Luke, John, thank you once again for updating investors this afternoon. Could I please ask investors not to close this session, as you'll now be automatically redirected for the opportunity to provide your feedback in order that the management team can really better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company.
Yeah.
On behalf of the management team of Alpha Financial Markets Consulting PLC, we would like to thank you for attending today's presentation. That now concludes today's session, so good afternoon to you all.
Bye.